Things just keep getting worse for the United States stock markets. Coming off of the heels of its worst week since the opening days of the coronavirus pandemic in March 2020, the S&P 500 fell further at the open of trading in New York on Monday, as concerns over looming interest rate hikes by the US Federal Reserve feed a growing aversion to risk. Hello everybody, welcome to Daily Crypto, and if you're new, make yourself at home. At Daily Crypto, we're trying to provide some of the highest quality contents regarding crypto, investment, and stock market out there. We do it for the knowledge, but the views are driving motivation as well. So if you like our video, please hit the like button, subscribe, and ping the notification bell to get notified when a new video comes up. Wall Street plunged in a broad-based sell-off on Monday, and the S&P 500 came close to its correction levels as the investors faced an increasingly hawkish Federal Reserve, growing political tensions, and persistent headwinds from the pandemic. Since the opening weeks of the pandemic, the Fed's easy money policies have helped propel stock prices even higher. But when the Fed signaled in December that it could raise interest rates at least 3 times this year and would accelerate the unwinding of the stimulus measures, it sent up a warning that the pandemic cheap money era is drawing to a close. Many analysts see the Fed getting even more aggressive this year to rein in soaring prices that are being fueled by supply chain snarls and the shortages of raw materials and workers. If we could put it in one word, what's causing this massive sell-off, it's uncertainty. First of all, the US Federal Reserve is due to convene its 2-day monetary policy meeting on Tuesday. The market participants will be parsing its concluding statement and the chairman Jerome Powell's subsequent QA session for clues as to the central bank's timeline for hiking key interest rates to combat inflation. The second reason is the tension between Russia and Ukraine. In a sign that geopolitical tensions are heating up, NATO announced it was putting forces on standby to prepare for potential Russian invasion of Ukraine. The third one is the Omicron COVID variant. Meanwhile, a report from IHS Markit gave evidence that surging infections of the Omicron COVID variant have caused a market deceleration of business activity in the United States. Nasdaq is down around 15% from its all-time high, while during the pandemic it was down above 30%. On the other side, the Dow Jones Industrial Average it's down around 7 to 8%, while during the pandemic it was down above 35%. And most importantly, the S&P 500 index, which is a better representation of the US stock market, it's down currently around 9.72%, while during the pandemic, this one was down more than 30% as well. Even though they look like massive sell-offs, here is a guide that I wish I'd have known when I started investing. When there's a market decline from 5 to 10%, it's called a pullback, and it takes around 1 month equal recovery time. When there's a market decline of 10 to 20%, this is called a correction, and roughly it takes around 4 months of recovery time. And when there's a sell-off of 20 to 50%, this is called a market crash, and it takes from 1 to 5 years of recovery time. So there is no need to panic, just remember to zoom out. Thank you guys for watching, be safe, and I'll see you on the next one.